Recently, not so long ago, U.S. stock markets lost over $3 trillion in value overnight as panic spread. Tech stocks got hammered, and even once safe companies like dividend-paying companies got pulled down. Prices fell fast, fear spread even faster, and now many solid businesses are sitting at their lowest levels of the year. In this video, I'm showing you 5 dividend-paying companies that have been dragged down to their 52-week lows but might actually be diamonds in the rough. I'll show you exactly why these stocks are down, why they're still fundamentally strong, and how much your $10,000 investment could grow if you buy while they're cheap. And at the end, I'll share the one company that could turn a single one-time $10,000 investment into a $1.4 million portfolio that pays over $13,000 in monthly dividend income. First off, let's talk about dividend stocks in the simplest way possible. Think of them as the elders of the stock market. They're not trying to sprint like brand new tech IPOs. They just send you small cash payments every quarter simply for owning them, almost like a thanks for sticking around. And during a messy market, that dependable income feels even better, because while prices jump around like they've had too much caffeine, dividends stay relatively steady. That's why people run to them when things get ugly. They offer stability when the rest of the market is having an emotional meltdown. Now, a 52-week record low simply means the stock has dropped to the lowest price it has traded over the last year. Not decades, not 10 years, just 1 year. It's the stock's lowest point on the calendar, and when solid companies hit that level, it often creates a rare window where you're buying quality at a discount. And speaking of markdowns, let's slide into the first contender. Fifth on the list is Equinix, sitting at about 23% below its recent highs. The easiest way to picture Equinix is to think of them as the behind-the-scenes landlord of the internet. They run the data centers and connection hubs that keep your Zoom calls stable, your Netflix shows streaming, and your entire online life flowing without you ever even thinking about it. They're not building shiny apps, they're providing the infrastructure that lets the digital world even exist. If the cloud had a home address, it would probably belong to someone like Equinix. Now, about that 23.29% price drop, not a bloodbath like some of the others, but still enough to raise eyebrows. Part of it is broad macro pressure, rising interest rates, higher cost of capital, and a tougher environment for growth plus infrastructure companies in general. Data center REITs, yes, REIT, real estate investment type structures like Equinix, get hammered when borrowing costs go up and investor mood shifts away from long-term infrastructure plays. On top of that, some customers may be delaying expansion or upgrades. Cloud growth might be cooling a bit, given economic uncertainty, which means less demand for new data center leases or services. But here's where Equinix can still look like a win for someone who prefers steady income over hype. Its dividend yield, thanks to the price drop, becomes more attractive. For a company that owns physical infrastructure with recurring demand, that recurring income stream is real. Unlike a trendy tech startup that may or may not turn a profit, Equinix has physical assets, long-term leases, and a mix of customers that tends to smooth revenue over time. That stability plays in favor of dividend-style investors. You get paid while revenues slowly accumulate, even if growth is modest. What makes Equinix stand out compared to, say, a consumer goods distributor or a payroll service firm is its global footprint and the structural shift towards cloud edge computing. As more companies, big or small, move computing, storage, and networking off-premises and into cloud data center environments, demand for what Equinix offers remains. That trend doesn't disappear just because markets wobble. Over the years or decades, that demand could grow, making a down price entry now look shrewd. Yes, there are risks: macroeconomic headwinds, rising costs, possible slowdown in corporate IT spending, or changes in how companies build infrastructure. But if you're in this for the long haul with a relaxed timeline and a preference for income plus relative stability, not explosive growth, owning Equinix shares when it's down 23% might be your version of buying the dip. Before we talk about where a long-term investment in Equinix might grow, here are the key numbers you'll want to keep in mind. Equinix's forward dividend yield sits around 2.49%. Its dividend has been growing at roughly 13.98% per year, and historically, the stock has delivered about 9.68% average annual share price appreciation. Now here's what happens if John invests $10,000 into Equinix and reinvests every dividend. After 1 year, that position is projected to be around $11,217. 10 years in, it would reach roughly $33,087. Stretch it to 20 years and you're looking at about $125,895. And pushing it to 30 years brings it near $590,476 with annual dividends around $42,200, which works out to roughly $3,517 a month. Nothing guaranteed, of course, but it shows what steady compounding can do when the business underneath keeps delivering. At number 4 is Automatic Data Processing, better known as ADP, and its share price has slipped about 16.8% from its recent highs. So that kind of drop might sound like a panic button, but for the patient investor, it could feel more like a suspiciously good sale sign. ADP is one of those companies that almost every business depends on without really thinking about it. They run payroll, taxes, benefits, workforce management, all the boring but absolutely essential HR tasks that companies need to keep running smoothly. Because nobody wants to mess up paying employees or staying compliant with regulators, ADP's services tend to be incredibly sticky. Once a company plugs into their system, they usually stay plugged in. Now, what happened to make the stock go down 16%? Well, it's a mix of market mood, macro worries, and what the numbers are saying. In the most recent quarter, ADP did beat expectations. Revenue rose and adjusted earnings per share came in better than forecast, but still, investors got cold feet because the company's guidance, what it expects next quarter, didn't shock anyone. And even slightly concerning, free cash flow margins dropped. Cash profitability declined compared to last year, which raised doubts about how much cash ADP really has to keep growing and paying dividends. We also have to remember that broader economic anxiety, weak hiring data, worries about inflation and possible recession means businesses may freeze hiring or cut costs. That directly affects demand for payroll and HR services. Indeed, some recent job market data has disappeared, which tends to spook payroll service providers like ADP. So yes, price drop. But here's where I lean into optimism. ADP raised its dividend recently. The quarterly dividend jumped to $1.70 per share, which works out to a forward yield near 2.7%. And historically, ADP has been reliable. It has raised its dividend many years in a row, making it one of those dividend stalwarts you can kind of trust for income. If you imagine yourself as a long-term investor grabbing a coupon clipper, someone who values steady cash flow over day-to-day drama, then ADP at this low price might look like a decent opportunity. The stock is trading well below its 52-week high, making its yield relatively more attractive now. And with its business model rooted in fundamentals, there's a fight for survival baked in. So yeah, ADP's drop looks scary on a chart, but if you lean back and look at the long game and ask, where will I be in 5 years, maybe this 16% dip is just the kind of entry point you might say yes to. Before looking at how an investment in ADP might grow over time, here are the numbers that matter most. ADP's forward dividend yield sits at 2.67%. The dividend has grown at about 12.13% annually, and the stock has delivered an average 12.36% yearly share price appreciation over the long run. So let's say John puts $10,000 into ADP and reinvests every dividend. After 1 year, his position could be around $11,503. 10 years in, it would reach about $40,464. Stretch that to 20 years, and you're looking at $162,883. And by year 30, the position is projected to be roughly $652,313, with annual dividends of around $14,184 or about $1,182 a month. Though it offers less long-term dividend income than number 5, about $14,184 a year from ADP versus $42,200 from Equinix, ADP makes up for part of that gap by adding around $61,837 more in total portfolio value over 30 years. It's a different balance of income and valuation strength that some long-term investors prefer. So these are great options, but there are even better options to come. And in the end, I'll share the one company that could turn a single one-time $10,000 investment into a $1.4 million portfolio that pays over $13,000 in monthly dividend income. Back to our list. At number 3 is Booz Allen Hamilton, and its share price has taken the biggest hit on this list, down about 44% from its recent highs. Booz Allen isn't some trendy startup trying to build the next viral app. They're the heavyweights behind government consulting, cybersecurity, defense tech, and large-scale digital modernization projects. When U.S. federal agencies need serious help, whether it be analytics, cloud migrations, cyber defense, Booz Allen is usually one of the first names they call. Now, about that hair-raising 44% drop, why did Booz Allen get walloped? Well, part of it is government spending cuts, shifting priorities, tightening budgets. Their earnings in 2025 disappointed some investors. Revenues for certain contracts were down, and the general contract backlog, while still substantial, started raising eyebrows among investors. On the flip side, for the dividend and income-hungry investor, there's still some comfort. Booz Allen currently offers an annual dividend of $2.20 per share, giving a yield roughly 2.65% to 2.75%, depending on share price fluctuations. Their payout ratio remains moderate and seems covered by earnings. They're not draining the till just to keep paying dividends. And when a stock falls this much, that same dividend suddenly becomes more appealing. You're essentially getting paid to wait for the government cycle to turn back in their favor, and historically it always does. Defense spending, cybersecurity upgrades, and digital modernization don't disappear, they just pause until budgets adjust. Here's the part long-term investors should pay attention to. Booz Allen still pays a reliable dividend, landing around a 2.64% yield at today's prices. And because its dividend has been growing at roughly 15.52% a year, the payout you start with today can look very different a few years down the line. Add in the fact that the stock has historically delivered about 10.56% yearly appreciation, and you're looking at a business that tends to reward patience once the government spending cycle picks back up, which it always does eventually. Now, let's say John invests $10,000 into Booz Allen and reinvests every dividend. Here's what the projections look like. After the first year, that investment is projected to grow to $11,320. Give it 10 years, and it could grow to around $36,663. 20 years pushes it to roughly $160,843, and by year 30, that same $10,000 could reach about $937,817 with annual dividends in the ballpark of $83,086, roughly $6,924 a month. Next up is Pool Corp, and this one sits at about 35.47% below its 52-week high. Pool is the world's biggest distributor of swimming pool gear, backyard living stuff, pool chemicals, pumps, filters, pool construction and renovation supplies, and related outdoor lifestyle gear. They supply everyone from pool builders to maintenance companies, landscapers, retailers, hotels, schools, pretty much anyone who touches a pool in any way. With hundreds of locations across North America, Europe, and Australia, they reach well over 100,000 customers. Now, the stock's taken a beating, down 35.47% from its 52-week high. That kind of drop can make your heart flutter, but it also puts the stock on sale, a maybe now or never window if you believe in its long-term story. So why did it fall so much? Well, pool's business is kind of cyclical, like summer pool sales. When interest rates rise, mortgages tighten, and people get nervous about big expenses. Pool construction, remodels, fancy backyard upgrades, all that stuff slows down. That reduces demand for the new pool side of pool's business, which tends to be more expensive and discretionary. Meanwhile, inflation and tighter consumer budgets also weigh on outdoor living and luxury home upgrade spending in general. So, pool got hit as people paused or canceled pool and backyard projects. But, and here's where the maybe this is smart comes in, not all of pool's business depends on new pools. A big chunk of revenue comes from maintenance, repairs, pool chemicals, replacement parts, stuff that's needed if your pool already exists. And in its most recent dividend announcement, Pool declared a quarterly cash dividend of $1.25 per share. That adds up to about $5 per share annually, giving a dividend yield around 1.7 to 2.05%, depending on share price levels. So for someone who's not trying to get rich overnight, but wants a mix of current cash yield plus long-term payoff, maybe in 5 to 10 years, Pool could be a decent dip buy. The business has size, distribution scale, and a global footprint. It's not just a local pool store. And because it's diversified between maintenance, construction, and outdoor living categories, there's sort of a built-in buffer if one of those segments slows down. Another thing, being the biggest in a fragmented niche industry gives Pool a competitive edge. Many smaller distributors or mom-and-pop pool supply stores can't match its product range, logistics, and pricing power. If economic conditions stabilize, say interest rates drop, housing picks up, people feel richer again, there's a runway for rebound. Pool building demand could bounce, luxury backyard projects could resume, and maintenance demand generally stays. Yes, there are risks. The industry remains cyclical and interest rate sensitive. Consumer discretionary spending might stay depressed, and profit margins could wobble. Its forward yield is 2.05%. Its dividend growth sits at a strong 17.34% per year, and historically, the stock has delivered about 11.41% annual price appreciation. Based on these metrics, a $10,000 investment into this stock is projected to be valued around $11,346 after 1 year. After 10 years, it could reach around $37,406. By year 20, it'll grow to $167,864, and by year 30, it could land around $1,032,962, with annual dividends of about $92,032, which is roughly $7,669 a month. Next up is our number one pick, and this one has a dividend yield that looks even more appealing thanks to its recent drop. We're talking about Watsco, ticker WSO, down about 37% from its highs. So Watsco isn't in the glamorous part of the market. They're not building shiny gadgets or launching new apps. They're the people who make sure heating, air conditioning, and refrigeration equipment actually get where it needs to go. Every time someone installs an AC unit, repairs a furnace, replaces a compressor, fixes a filter, or services a building's HVAC system, Watsco is usually somewhere in the supply chain making that happen. Now, about that steep 37% drop, WSO's recent performance took a hit. Their revenue in quarter 2 of 2025 dipped noticeably. GAAP revenue came to about $2 billion, missing estimates. Still, weirdly, they managed to post a record gross margin of about 29.3%. What gives? The hitch seems to be in demand. The industry itself is undergoing a shift, a regulatory-driven transition to new A2L refrigerants, which disrupted inventory cycles and slowed down new equipment demand. On top of that, milder weather and slower home building activity dampened demand. Fewer new houses being built means fewer new HVAC systems being installed, so revenue volume dropped. But despite fewer units sold, Watsco squeezed more out per unit, margins went up, operating efficiencies improved, and even with macro headwinds, they kept their balance sheet clean. Cash on hand is strong. Debt is basically none, giving them breathing room. Then there's the dividend story. Watsco boosted its annual dividend nearly 11% this year to $12 per share and has now paid dividends for 51 consecutive years. What makes Watsco different from, say, a software startup or trendy EV stock is its scale and resilience. They're the largest distributor in the fragmented North American HVAC market. They don't rely on hype. Their business is boring, but real. Homes need HVAC. Apartments need maintenance. Industrial buildings need replacement parts. Over time, that steadiness matters. Yes, the next few quarters might be rocky. The refrigerant transition, housing slowdowns, and maybe softer consumer spending could keep demand bruised. But if you're in this for the long haul, dividends, stability, and a possible rebound once the transition completes, Watsco's dip might feel like buying comfort on sale. Before we look at where $10,000 could grow over time, Watsco's forward yield sits at 3.47%. Its dividend has grown at about 15.37% per year, and historically the stock has delivered around 10.43% annual price appreciation. So let's say John puts $10,000 into Watsco today and reinvests every dividend he earns. After 1 year, that investment is projected to be around $11,390. 10 years down the line, it might sit near $39,691. After 20 years, it could reach roughly $198,676, and by year 30, the projections show a valuation of $1,431,931, with annual dividends of about $161,603, which comes out to around $13,467 a month. Want to know how a simple $5 a day investment can grow into a portfolio that pays more than $8,000 a month in dividend income? Click the video on the screen to find out.